Hey everybody, Jimmy with Joint House Properties, back with my Atlas Wealth buddies, Ryan and Brad. Want to say hi, Phil?
What's up, guys?
Good to be back. So this week's video, we're going to talk about the DalBar Report. And this is a report that, in my gut, I always knew this was happening. I always knew that when you say the S&P gained 8%, I knew that 8% was not going into the investors' pocket. So my boys at Atlas Wealth, they actually backed it up with some numbers. So take it away, fellas.
All right, so we're going to title this little section here, Myth versus Reality. And I think so many people, this is what we struggle with, because we're told and we see and we think that the market is doing one thing. And the myth is that, hey, if the market is earning X%, then we should also be earning X%. So there's a really cool study that comes out. It's an independent study that comes out every single year for the last 22 years. And Google it, you can get it online. It's called DalBar's Annual Quantitative Analysis of Investor Behavior. So really, what the heck does that mean? What it really is, it's a measurement of what a given index or fund is doing versus what an average investor receives. And you can see they graph it out. So this one ended in 2015, going back the previous 20 years. And the S&P averaged 18.17%. So the average...
8.17.
Oh, 8.17. So the average investor could look at that and say, hey, if I put my money in the S&P or a mutual fund that mimics the S&P, I should likely be able to receive somewhere in the neighborhood of 8%, right? But the average investor actually receives far less than this. And these numbers actually improved slightly in 2015. And in 2014, it was horrendous. But what you'll notice here is every single year there are two different lines, right? And there's a green bar and there's a red bar. And there's always a difference between the green and the red bar. So the green bar is tracking what the S&P did, and the red bar, you got it, is tracking what the average equity fund investor received. So take a guess, Jimmy. What do you think the difference is? What is the average investor getting versus what the market is doing?
They're getting about half.
Getting about half. You got it. So the average investor over the same 20-year period of time invested or earned about 4.67%. So
I just can't imagine hosing any of my investors like this.
Yeah, and how that...
I can't imagine telling them how great we're doing and then only letting them have half.
Yeah, and how that charade can continue year after year after year and have trillions of dollars constantly pouring into the market, because people think that's the only solution to grow your money, right?
And that's Jimmy, that's the smoke and mirrors game that's happening here. Is they're using this unrealistic standard. We were kind of talking about this earlier, where how can there be this difference between the S&P and what investors are getting? And one way to think about it is the S&P doesn't really exist. It's a benchmark. You technically cannot buy the S&P 500. You can buy mutual funds whose goal is to mimic that as can, but you cannot buy the S&P 500. The best example for real estate investors, it'd be like trying to buy into the Price, Schiller, whatever, the home index, right? Or saying that because I own real estate, if the home index went up by 3%, then therefore all my property went up by 3%. And that's not the reality. There's the underlying investments that the investors own, and then there's the broad aggregation of the entire market. The S&P 500 is the broad aggregation, but you as an investor hold individual securities, whether that's stocks, bonds, or mutual funds. So your portfolio is naturally going to act differently than the broad aggregation. Does that kind of help explain? Hopefully that helps explain a little bit where some of that difference.
Another thing about the S&P 500 and selling the whole idea that the S&P goes up 8% every year is they get to pick the winners. The same 500 companies that started in 2001 are not the same 500 companies that are in 2015.
Yep.
And I wish I could look at my real estate portfolio every year and throw out the 10 losers.
Yeah. Yep, without any cost, without any downside, we just, we're going to eliminate that one and replace it with this one. What a lot of people don't realize, The Dow, which is another market aggregation index, there's 100 companies in that index. Of the original 100 companies that started in that index, is over 100 years ago, how many do you think are left?
It's one. It's GE, right?
One. GE. That's it. One company. So the whole buy for the long term is a complete myth, because if you bought the Dow or bought a share in each of those companies, guess what? 99 of them would have lost you money. And you would have had one left. Okay?
So let's put some numbers to that.
Business. We just need to start a fund where we get to pick the winners.
Well, let's actually put some numbers to that, because this is the crazy thing. This is why people invest. It's for the myth of the market, but the reality is far different. And I think the challenging part, and this is, I know, something that I faced in my life. When I first got out of college, I did what everyone else did. I got a job. I put my money in the company-sponsored 401k, and I thought I was going to be set. And, think about it this way. This is where so many people find themselves. Let's say you get out of college and you're saving $15,000 a year, right? And you think the market's going to earn 8.17% because that's truly what the market is earning. You think that's what you're going to get. And if you just do some long-term forecasting and say, okay, if I do this for 30 years, I'm going to have $1.8 million, saving $15,000 a year, compounding at 8%. And then you just kind of turn your eyes, close your eyes, cross your fingers.
Compounding at 8% doesn't mean 8% average.
That doesn't mean that's what you're going to get. And this is when I first saw this pissed me off so bad. But here's the thing. I'm gonna go give you just a little analogy, and it's average.
Okay.
So let's do average versus actual. So Jimmy, let's say you come to me, and I'm an amazing investor, and I want to be your investment advisor, and you come to me and you say, hey, Ryan, I'm going to invest my money with you.
And if you were amazing, you'd be working for a hedge fund anyway.
You got it. But you're going to be my first guy.
Tell me you're a basic financial planner, and you're going to allow me to buy retail.
Okay, that's true. So here's the caveat. I'm going to guarantee you, in fact, I'm going to promise you, if you invest with me for 4 years, I will guarantee you a 25% rate of return on average. That sounds pretty decent, right? So let's say you decide to be my, decide to be my first client. You invest $100,000 with me, and the first year that you invest your money with me, I'm stoked. You're my first client. And I go out and I crush it. I earn 100% rate of return. I take your $100,000, I earn $100,000 in interest, and I double your money to $200,000. Now you're pretty excited about that, so you go out and start telling all of your friends that, hey, I've got this amazing advisor. He just earned me 100% rate of return. So you start sending all your referrals to me, and the next year, I don't really know what to do. In fact, I lose 50%. But here's the caveat. I just lost 50% on $200,000. So I lost $100,000. We're back to where we started. The third year, I got it kind of figured out. I know how to work with larger groups of people. So I earn another 100% rate of return. And the fourth year, I decide to skip town. Right. What you can see is over this 4-year period of time, I gave you exactly what I promised you. Your average rate of return was 25%. If we add up these 4 numbers here and divide it by 4, you averaged 25%. But your actual return was 0. You started with 100, you ended with 100, and one of the things I didn't even tell you about, what if I charged you a 2% fee on top of that? You ended up losing money even though you averaged 25% rate of return on that.
But you got your realized gain.
I got my realized gain, and that's the myth of the market. People think they're getting one thing, they get something completely opposite, and what happens too, more often than not, is once they start to look at what they actually have, in their 50s, they start thinking about retirement, what they've been saving for all along anyway. They realize they ended up here. They ended up in, more closer to the reality. And rather than having 2 million, they have like 200,000, and they're freaking out because they should have been, 75% of the way to retirement. So,
and then I'm just gonna kind of go off subject for a quick second, but the backside of that too is during the next crash, it's not that big a deal. It's just the people on Wall Street getting hurt. There's no reason to cry and for us to support a bailout or bail in.
Yeah.
Just because the S&P is cut by half, it doesn't mean that the factories still aren't working, that cars still aren't working, that people still don't need things and aren't still trading.
Yeah, it's funny because I grew up on a farm in Central Washington, and I joke, my brother is now running the family farm that we grew up on, so we kind of have the running joke that anytime there's a crisis in the world, my brother will call me and be like, man, none of my tractors will start. and my hay isn't growing, and I was worried the sun wasn't going to come out, because then life moves on. It doesn't affect the average person, but they're selling it to us like we are somehow part
that we're somehow interconnected.
Bigger system, when, like you said, the average person is in no way connected to what's going on that side of it.
And if you read Tom Woods or David Stockman, they have the numbers to support the fact that during the last crash, if they just would have let it crumble, everybody in Middle America probably would have been fine.
And they'd have been better off because they'd have kept their own money and done what they wanted to do with it, rather than pumping it back to Wall Street and having them get bailed out and benefited from it.
So we kind of went off subject there. Sorry, fellas.
No, you're good, man. So here's kind of the conclusion to all this, right? You know, I've got this scared little dude here riding the roller coaster, and I think that's how so many people feel. So many people have a financial plan that's built on hope, right? They're hoping that they earn the 8%. They're hoping that their financial advisor has their best interest in mind. They're hoping that taxes stay low because they've been convinced that they're supposed to defer those taxes. And all of that list, it goes on and on and on. But here's the roller coaster ride. I mean, this is that average versus actual thing. In 2000, the market took a nosedive. It took the next, almost 7-8 years just for the people to gain back what they had originally lost. And then it dove again. And then it's back up. And the question is, where is it going to go from here? Who knows? But why don't we get off the roller coaster? In fact, the average investor over this time, adjusted for inflation, is losing money in the market, even though they think they're earning 8%.
And this is before fees.
How many years is that?
That's from 2000 ending in, this graph ends in 2014. But that literally is, that's 15 years of lost. I mean, imagine that. That's half of your working career. If you start saving in the year 2000 all the way up to today, and you've lost negative 6% adjusted for inflation.
Yeah. Or Ryan, draw a compound curve real quick for me. And then split that in half. So either you spent the whole first half getting nothing, or you were a diligent saver and you put money aside and you were just to hit that upward vertical motion of that compounding curve, and guess what you got? A flat line.
Yeah. And
that's how we meet so many investors, is they've got a couple $100,000 saved because they put it aside, but they're not getting this compounding curve which was sold to them.
Well,
because for the last 15 years, the only reason it goes up is because they're putting money into it. The market is returning a flat return, or just something barely a couple percentage points.
Well, and here's the challenge.
I ask myself, is life insurance and real estate that great, or is the competition just that horrible? And I'm going with the competition just that horrible.
It is, man, and that's really it. So kind of the last part here is, let's go back here. What's the solution, right? It's getting off the roller coaster. And Jimmy, this is where you and I mean, this is where we come in. I mean, so many people, when they're looking for financial advice, they're looking for someone that can beat this, right? Hey, if this advisor over here is getting you 7%, maybe I can get you 7.5%. So come work with me. But it's all the same solution to the same problem, and it's not working. So plan B is, it's not doing this better. It's not doing that in most cases. I mean, if we look at anyone who is independently wealthy, it's not because they're an amazing stock investor or a mutual fund manager. It's because they're doing the exact opposite. They're putting their money in places that they control, that give them multiple ways to make money, that reduce their taxes, that provide cash flow. And a lot of what we teach is, man, if you've got money, why not put it into real estate? But we also teach, if you have a properly structured life insurance policy filled with cash value, your money can literally be working and growing in two places at the same time. And at the center of this is you being in control. So that's really what it's all about. If we know where you are today and we know where you want to be tomorrow, and we're using tools that we control, it's really drawing a straight line between those different points. Whereas over here, if we know where you are today and we know where you want to be tomorrow, but we don't control anything, it might look something like that.
Jimmy, I want you to chime in here for a second. We get a lot of people that we share this with, and they say, yeah, I've known real estate needs to be part of my portfolio, but I know my Uncle Bob did real estate and lost his shorts, and I don't want to manage tenants and fix toilets and do all that garbage. So there's a lot of apprehension for somebody wanting to get into something like real estate. The life insurance policy side, that's pretty easy.
Right.
but we talked about this. That's not enough. We've got to have an engine to that locomotive, moving us toward financial independence. So, Jimmy, how does somebody participate in real estate without having to quit their job and buy a Carlton Sheets course and spend all night reading and hustling and doing that? How can they do that? Like myself, I've got a busy career. I've got 5 kids at home. How is that possible?
Either buy turnkey or you private loans.
It's more possible than ever, right?
Right. My first successful real estate investment was a private loan. I was getting killed on my first few real estate deals. And the private loan is just the simplest and it's the cleanest way to do it, especially if it's just coming out of a life insurance policy.
Yep.
At the end of the day, when you do a private loan, you're just you're benefiting from an asset-backed security.
Yeah.
You're getting a yield off something that's not a piece of paper on Wall Street.
And Jimmy, how good are you at doing real estate?
I'm okay.
You're pretty good, right? It's what you do full time, right?
Right.
So this is a way for them. This is what I explain to my clients is there are people out there that are really good at real estate and want to do that all the time, full time, but their biggest restriction is having enough capital to go out there and buy it. So let's find somebody with, I was going to say, we want to find somebody with the capital and then connect them with you, and you bring the expertise, they bring the capital, and everybody wins.
Right. And if you find a real estate investor who's not looking for capital, you're finding a real estate investor who's probably going out of business. Real estate, you're always looking for capital everywhere.
Yep.
But I like how you say it, Jimmy. I mean, if you look at your investments over here, it's not backed by anything. When the market goes down, you go down and you take the biggest hit of all. Whereas these private loans that you do, it's backed by a tangible, verifiable piece of real estate that is always in demand. And you have a very, very unique way that you do these private loans where the investor's in first position. There's a lot of benefit. There's short-term, there's long-term opportunities. But it's a way to get real estate-like returns. So if you don't want to be the one out there fixing toilets, dealing with termites and tenants, you can get real estate-like returns without doing real estate. And I know you use qualified money when it's self-directed. So a lot of clients, that's really a good opportunity is to say, look, my money was here in an IRA. Why not self-direct and put yourself into more of a control position where you know what you have, you know what you're getting, and you can now start to bridge the gap between what you want and where you're at.
Right. And we buy these properties at half the market value. 1, for a great deal for us, but 2, as a means to protect the investor.
Yeah.
So if the estimate is cut in half, the investor is still protected.
Boom. All right.
And if this estimate is cut in half, I still owe them whatever I borrowed from them.
Yeah, because they're in just such a more secured position, and the backing of it has been fantastic. So this has been such a good marriage of ideas for our clients. We get your money out of Wall Street by using the life insurance policy, get it accessible to you to then be able to put it to work through, a guy like Jimmy. And
when I tell the investor they get an 8 or 10% return, that means they actually put 8 or 10% of that money in their pocket, not half.
Wait, you're not aggregating everything and then keeping half of it?
No, whatever I'm contractually obligated to give them, I give them.
It's amazing.
Yeah,
it's amazing.
Love it. So it's really that plan B. It's this whole, man. I love this picture up here. Don't be this guy. Don't be riding into retirement like this, scared, anxious and hopeless. Achieve your financial goals with confidence, security, and control.
Yep. And then I'll link to this report. I'll put a card on the YouTube video, and then I'll link to it on our website, and I'll link it to your guys' website, put a card as well. So thanks for tuning in, everybody. Talk to you later.